Welcome to the Wednesday edition of Tech Stocks Daily. Strap in because we've got a whirlwind of tech tales to dish out. Today, Google wows with a colossal $75 billion AI ambition, but takes a stock hit from cloudy underperformance. Apple finds itself entangled in Chinese antitrust drama while fighting off revenue stagnation worries. Over in Redmond, Microsoft's AI investments hit impressive numbers, but investors are left wanting more. And brace yourself for a sizzling appetizer from Portillo's as we eagerly await their fiscal feast. Don't miss out on today's exhilarating tech stock roller coaster. Hold on to your cappuccinos, folks, because Alphabet, Google's parent company, has been making headlines left and right, mostly for good reasons, but a few head-scratchers too. Let's dive headfirst into this intriguing mix of delightful data and cloud conundrums. First off, Alphabet reported its fourth quarter earnings, and oh boy, did they deliver some juicy insights. They popped the lid off with a revenue increment of 12% to a whopping $96.47 billion. Yes, that's billion with a B. However, this still fell below Wall Street's expectations, and the stock market was not amused. We're talking about a 7% drop. Ouch. Seems like those analysts were hoping for an all-you-can-eat buffet, but only got appetizers. Now, while the dough was rising slower than a sourdough bake-off, some areas still managed to thrive. YouTube kept waving its charismatic wand with a 13.8% increase in advertising revenue. A little fairy dust from US election advertising may have helped, but who's counting, right? Also making waves was Google Search, which reeled in 12.5% more than last year. Apparently everyone needs to know in 2024. However, if there's a villain in this story, it would have to be Cloudy McCloudface, Google Cloud, for those not into silly nicknames. Investors had pinned Google Cloud as the prodigal child, expecting it to swoop in with mind-blowing growth. Cloud services posted a decent enough 30% increase in revenue, but came in a smidge below expectations at $12 billion. That kind of miss tends to chill enthusiasm like a snowstorm in July. Meanwhile, Alphabet is planning to channel some serious cash into artificial intelligence with a CERN-sized $75 billion in capital expenditures for 2025. Most people agreed that's a lot of guac for potentially delicious AI tacos. CEO Sundar Pichai laid it out straight. AI is a huge growth channel, and they aim to lead the ride. But until then, someone needs to explain to the investors that you've got to crack some eggs to make an omelet. In a twist worthy of a Netflix drama, a former Google engineer named Linwai Ding spiraled into the limelight. He's facing charges for allegedly swiping AI trade secrets with the potential of, get this, up to 175 years behind bars. Looks like Ding paid more attention to the art of theft than Google development ethics. But hey, accusations for now. So why is Google in the news today? It's a complex tapestry. There's the elation over AI progress, mixed with cloud underachievements, intellectual property dramas, and extravagant spending plans. One thing's for sure, Alphabet is fully engaged in tech's high-octane roller coaster, teetering between exhilarating news and daunting clouds. Investors may be caught biting their nails, but tech enthusiasts will undoubtedly keep watching every plot twist. Apple was bringing the heat to this news cycle with a mix of regulatory drama, financial insights, shareholder optimism, and a dash of pricing updates for its services. Let's break it down. First off, Apple shares were feeling a bit under the weather, dipping due to potential legal rumblings coming from China. Chinese antitrust officials are reportedly preparing to scrutinize Apple's App Store practices, focusing on those all-important fees and payment services. It's not just an isolated spat. These talks apparently intertwined with trade tensions piqued by US-China tariff shenanigans. Imagine this like the tech equivalent of a dramatic soap opera, where Apple's narrative takes an unexpected twist. Regulators believe Apple might be playing hardball with high fees and anti-competitive practices. This isn't the first time they've clashed with a regulatory body. The European Union recently gave Apple a financial slap on the wrist to the tune of over $1.8 billion for similar issues. So while Apple navigates the tightrope of international tech Titanic, its stock took a humble stumble today. Transitioning to the fiscal examination vibes, Apple was under the financial microscope, showcasing its robust yet challenging financial landscape. Despite having mammoth sales numbers, it's facing a bit of a slowdown in revenue growth, contrasted by its sky-high profitability metrics and towering return on equity. Industry analysts point out that this indicates solid financial health, but also underlines room for improvement in terms of breaking the revenue stagnation shackles and getting growth more in sync with broader industry trends. Amidst these elsewhere woes, on the lighter side, we've got an optimistic analyst on Wall Street bullish on Apple like it's the next Jurassic Park blockbuster. He pegged the stock for growth, setting a tantalizing target of $260 per share. Driving this optimism is Apple's potential sunbathing in markets emerging with untapped enthusiasm for its products and the golden glow of its services revenue, which has shown notable upwards trots. So between dodging price hikes and charging into new consumer bases, Apple's got a battle plan. But before we wrap up, let's delve briefly into Apple's latest move in the world of product services. They announced a small price bump for Apple Care Plus monthly subscriptions across the US. Adieu to the upfront purchase option in stores, a transition that rings till the cash registers hum with subscriptions. This reimagined payment model draws both enthusiasm and groans, with price changes minor, but worth noting for consumers keeping an eye on their tech support budgets. So while Apple juggles impending probes, fiscal fortunes, investor hopes, and restructured product packages, their day in the news was indeed a multifaceted reflection of their high-stakes role as the reigning titan in technology. As always, Apple's journey in integrating hardware, software, and financial fortitude remains a key narrative worth watching. Oh, Microsoft's making waves today, and we've got two main stories to unravel for you tech enthusiasts. Buckle up. First up, Microsoft versus its peers. Everyone loves a good rivalry, right? Well, we're diving into a competitive analysis of how Microsoft is faring against other software industry titans. Microsoft's got its fingers in many pies, from Windows operating systems to the Xbox and Azure cloud services. But what does that mean financially? Despite some hiccups, like a 12.27% revenue growth rate that's actually less than the industry average, Microsoft's still been showing strong profitability metrics. Their price-to-earnings ratio and price-to-book ratios suggest their stock is a good catch on these fronts. Translation: it might be undervalued when compared to the industry's big fish. However, the price-to-sales ratio is on the higher side, implying that its stock price based on sales performance is a tad expensive. In simpler terms, while Microsoft shines in some areas, it's got gaps when it comes to sales growth, which should make investors think twice. Those balance sheet curves are looking a bit like a sine wave right now, amigos. And speaking of sine waves morphing into flatlines, let's talk about why Microsoft's stock is taking a bit of a nosedive. The trigger? Earnings report blues and soaring AI expenses. Yep, Microsoft posted a fiscal second quarter earnings report, and while it topped Wall Street predictions, shareholders weren't feeling inspired. Cue the chorus. Why isn't Microsoft's AI spending printing more money for us? The tech giant did manage to drum up $13 billion in AI-related revenue, marking a 175% surge from the previous year. Impressive, right? Not so much when you consider their mammoth $261 billion total revenue. Even with AI's thrilling expansion courtesy of Microsoft's cloud and AI services wowing investors, the cost of ramping up data centers and capital expenditures has more than doubled, creating some unexpected turbulence on the profit flight path. In comparing growth, Meta Platforms disclosed Q4 earnings growth of a stunning 50%. Microsoft's grappling with a more modest 10%, not painting the rosiest of pictures for enthusiasts of future gains. To sum it up, it's hard to woo the investors when sprawling investments don't swiftly inflate earnings. Microsoft needs to play the long game, proving its capital czar title by refining how it converts those eye-watering AI spendings into tangible windfalls. That about does it for Microsoft today, folks. Whether you're rooting for it, skeptical about the spendathon in AI, or just here for the drama, one thing's for sure, Microsoft knows how to keep techies glued. Until the next swipe or scroll, stay savvy. Hey tech fans, fellow foodies, and lovers of all things Chicago style. Hold on to your hot dogs and grab a forkful of that famous chocolate cake, because today we're diving into news that marries the financial world with mouth-watering treats. Portillo's Inc., the fast casual restaurant chain renowned for dishing out Chicago-style favorites like Italian beef sandwiches and hot dogs, is front and center in today's financial headlines. In case you haven't marked your calendars yet, Portillo's, listed on NASDAQ as PTLO, has everyone eagerly awaiting its fourth quarter 2024 financial results announcement. Circle February 25th, 2025, folks. That's the day you'll want to wake up early for, at least if you're an investor or just really dedicated to understanding the financial side of your favorite eatery. What's happening is that Portillo's will drop their much-anticipated financial report before the market opens on that Tuesday morning. But wait, there's more. The day isn't just about numbers on a page. No, it's a full-on audio experience. The company's CEO, Michael Osanloo, and CFO, Michelle Hook, will host a live webcast at 10 a.m. ET on their investor relations website. Whether you're at home or sneakily tuning in from work, this webcast is a chance to get the lowdown on Portillo's performance straight from the top dogs themselves. For those who still rock a trusty telephone or just prefer that old-school approach, don't worry. You can listen in via phone by dialing the provided numbers, whether you're chilling in the US toll-free style or calling internationally. If you miss it, don't sweat it. A replay will be available shortly after, so your FOMO can take a breather. Now, stepping out of the numbers for a second, let's appreciate the journey behind this iconic brand. From back in 1963, when Dick Portillo first parked his small hot dog stand, dubbed the Dog House in Villa Park, IL, the brand has grown to boast over 90 locations across 10 states. And hey, if you crave their delicious offerings, but live far from one of those 90 spots, don't worry, they ship nationwide. Whether it's Chicago-style goodness for a special gathering or just your typical Tuesday night dinner, you can order via the Portillo's app or website. No capes required. This brings us back to you, dear viewers. What are your thoughts? Are you looking forward to this financial reveal as much as a combo plate? How do you think these results will impact Portillo's stock performance and expansion plans? Let me know your thoughts in the comments. And while you're there, share your buns-up favorite item on Portillo's menu. Hit that like button if you enjoyed today's tasty financial tidbit, and subscribe for more piping hot tech updates. All right, let's put on our investor hats and take a closer look at Alphabet, aka Google. With today's spicy mix of both positive momentum and some stalling factors, this one's a dynamic roller coaster. First, the good stuff. Alphabet hyped up its AI ambitions by showcasing a whopping $75 billion investment plan. That's sort of like betting on AI becoming the next big thing since someone first streamed cat videos online. Plus, YouTube's and Google's core search are still strutting strong like rock stars on an encore tour. Always a comforting sign for investors. However, the cloud's underperformance, notably dragging the revenue increase below expectations, dinged the stock's appeal. Expectations were placed sky high, and Google Cloud just couldn't quite tickle the stratosphere as hoped. Now enter Lin Wai Ding. This AI-related legal drama could cast some shadows if it turns into a full-blown scandal. Plus, with shares dipping 7%, the vultures might circle, while fingers point at Cloud's unlikely hero status, triggering a stock sell-off from those with jittery nerves. But remember, Alphabet plays the long game. Dips can mean opportunities for those willing to dive in and hold on tight for Google's long-term AI vision. Still fits the innovator narrative, but patience is essential here. So, would I advise selling, buying, or holding Alphabet based on today's whirlwind news? Personally, I'd call it a with caution for existing shareholders who believe in Alphabet's growth over the next few years. If you're not already in the mix, wait and watch how this AI investment unfolds. Opportunities might sweeten if the drama deepens temporarily. And as always, remember to do your own research. Every investor has their strategy. I'm just here to offer a snapshot in today's tech excitement. What do you think? Let's hear your thoughts. Wow, what a day on the tech stage. We've seen some roller coaster moments with Google's bold moves on AI, despite some cloudy revenue disappointments. Apple's got its own blend of regulatory dramas paired with an optimistic growth outlook on Wall Street. Microsoft is keeping us entertained with impressive AI revenue growth, but not without some cost-side concerns. And let's not forget Portillo's whetting our appetites while we anticipate their financial revelations next year. The stock market saw some tumbles and turns, underscoring the heated mix of anticipation and investor scrutiny. For all you tech fans and market watchers, the narrative keeps getting juicier. If you enjoyed today's rundown, don't forget to hit that like button, subscribe to the channel, and share the video with your tech-savvy friends. And be sure to swing by tomorrow. There's always more happening in this fast-paced world of tech.